being there. But we'll continue this conversation with Sandip Bansal, the Deputy CIO at ASK Investment Managers. Sandip, good afternoon. Thank you for joining in. Since we are on the subject of IT, we'll get to the markets in just a bit as well. But IT has been the focal point, right, of this entire conversation, with the US fearing that it will slip into a recession, maybe in the second half of this year, maybe in 2026. Stocks have been beaten down, but despite being beaten down, they are still expensive. What do you do in a sector like this where there is a lot of fear compared to greed? Do you still take a bet here, or do you stay away from it and look for better opportunities?
We think that there are better opportunities available in the market than the IT sector because the uncertainty that is surrounding the sector is just too much. There are too many variables at play, which will be difficult for us to figure out. And while the stocks might have corrected from their peak levels, they are still not attractive given the likely growth that is going to pan out. So our idea is more to focus on domestic oriented businesses, more to focus on manufacturing oriented businesses rather than have exposure to sectors like IT, which are more of a macro play on the entire US economy and discretionary spending, wherein the risks could be relatively higher.
Right. So what are these better opportunities, Sandip, that you're spotting in comparison to IT? What's on your radar right now after this recovery that we have seen from the lower levels as well?
Yes, there has been, around a 5% kind of a recovery in the markets. Maybe the broader market, specific stocks have rebounded more sharply. But we believe that still there are opportunities which is available, on discretionary consumption. We are likely to see the boost from the tax cuts flow through the next year. There is anyways a uptick in the rural economy. Urban consumption is also likely to bottom out in a quarter or so. Then there is going to be the pay commission effects that is going to come in from next calendar year onwards, perhaps. So discretionary consumption is something which we are bullish on. It's a domestic granular story. In addition to that, domestic manufacturing infrastructure, these are businesses that we continue to like. We believe that this entire tariff episode that is playing out ultimately is going to lead to an advantage India kind of a scenario. Obviously, there would be short-term hiccups and pains because supply chains take a lot of time to reorient themselves, and there is potentially a global growth slowdown as well. But once all of this settles down, Indian manufacturing should end up as a big beneficiary. Infrastructure, we believe, especially on the power side, government thrust and capex continues, and there are various ways to play the entire power story. In addition to that, healthcare as a space is something which we like. While there is an overhang in terms of what could be the ultimate tariff announcements on the entire pharma space, given its essential nature, given the fact that Indian companies contribute around 40 to 50% of the generics market in the US, we believe that we have a solid footing, and the impact of tariffs, if at all, might not be that high. In addition to that, there are domestic-oriented pharma plays also available, which we think will continue to do well.
Okay. Hi, this is Rima here. Talking about the India manufacturing opportunity. Now, there are companies like a Dixon, there is a Syrma SGS. Now, Dixon is, in a way, a little bit stolen a lead over Syrma SGS purely in terms of a stock price. And then there is an added tailwind about electronics because Dixon supplies to a Motorola. So it's got a bigger play in the smartphone market, which could shift to India as it's disadvantaged China. So can you tell us, because in your top holdings, you've got a Syrma SGS. So a lot of our viewers ask us, why not Dixon, right? Why is Syrma SGS? So give us your thoughts on this.
So Rima would not be able to talk stock specifics, but we have quite a few names across our different portfolios in the broader EMS space. There are different drivers for each of these stocks. But if we look at the broader sectoral story, the Indian EMS space only caters to a fraction of the domestic consumption requirement, and the export market is a multiple of that. So even if we are able to just fulfill the domestic requirements of the next few years, there is a huge headroom for growth that is available. In addition to that, we will see this global diversification of supply chains, wherein perhaps there is going to be a higher levy of tariffs on China, which is going to incentivize the move towards India. If we look at these different plays that are available in the EMS space, each of them has, while the businesses are quite similar in one sense, in another sense, there are different drivers for each of them because they have their own niche areas which they cater to. Some of them could be more diversified. In few cases, valuations could be more attractive. In few cases, the return on capital employed or capital efficiency is very good. And in a few of the other cases, there are newer growth drivers in terms of adjacencies to their businesses or backward integration that they are doing. So we actually like the entire space.
You know, Sandip, because of all of this tariff-related drama that we've been unfolding over the last couple of weeks, there are a lot of sectors that are hanging in the balance right now, be it auto, be it pharma, with Donald Trump saying one thing one day, the other thing the other day. Now he's going to consider tariffs. He's already warned of pharma tariffs coming in. So let's ask pharma here. What do you do in pharma? Because most of these companies, say for the likes of Gland or Aurobindo, they have significant amount of revenue coming in from the US market. How does this significant quote-unquote tariff imposition impact a sector like pharma, and how do you position yourself here?
Yeah, so, a few things are relatively certain in this environment. Maybe for the market, for now, the peak of fear is behind because of the various reprieves that have been gotten around in the tariff drama over the last few days, whether it be in terms of imposition of timelines or, certain sector-specific carve-outs. Second thing is that markets and tariffs are going to remain uncertain for a length of time because there's been a 90 days window. The US perhaps has to negotiate 75 to 90 trade deals with different countries during this period of time, which seems quite unlikely. So this tariff uncertainty and overhang in the market is going to continue for the next few months. Perhaps the market will learn to make peace with it and move on. Thirdly, it does seem that in the overall scenario, it is still going to be beneficial for India. As far as the pharma sector is concerned, what we like are plays that have a mix of domestic exposure primarily, but also domestic plus overseas exposures. In the US market exposure, what we believe is, given the essential nature of pharma, given the fact that Indian producers are 40 to 50% of US generics market, given the cost advantage, given the scale efficiencies that India can offer as a country, and given the timelines associated with reorientation of supply chains that might be required, we believe that the ultimate impact on India might not be as severe as the market might be fearing at the current point in time.
All right, Sandip, thank you so much for sparing time and joining us today with your views on the various sectors that are currently in the news. Time to take a short break, but